Good afternoon, everyone, and thank you for joining us for our Q2 of 2026 call, which we have titled Second Order Opportunities. Let me begin with the central point of this presentation. The market's main concern is not the Iran conflict in the abstract. It is much more specific than that. The real question is whether energy and commodity flows through the Strait of Hormuz remain sufficiently intact to prevent a temporary geopolitical shock from turning into a broader macroeconomic event. That is the fulcrum. That is the variable that matters most for investors right now. Our base case remains that flows do continue, perhaps imperfectly and noisily, but sufficiently to avoid a global recession, and more specifically, a US recession. That view rests on the simple fact that nearly every relevant actor still has incentives to avoid a prolonged disruption that would damage growth, inflation, and political stability all at once. If you look at this first chart, the historical message is important and, in my view, calming. The chart tracks S&P 500 returns around major geopolitical shocks since 1950, and the broad pattern is that markets initially react badly, but over a 12-month horizon, they usually recover as long as the world does not lose critical productive capacity or suffer a sustained interruption in essential commodity flows. The median S&P 500 return 1 year after a geopolitical shock has been more than 11%. So the lesson of this chart is not that geopolitical shocks are harmless. The lesson is that markets are often better at absorbing them than headlines suggest, once investors understand the true economic transmission channels. That is why this moment matters. We will make the case that some and possibly most of the disrupted volume is likely to resume flowing. We should point out that Insigneo had already recommended a tactical long oil hedge earlier in the year when the probability of military strikes began to rise, and then recommended closing only half of that hedge as Brent approached $100 per barrel. So this is not a complacent outlook. It is a conditional one. We acknowledge that recession risk has risen, but we are still treating recession as a risk case rather than the base case. In fact, the subjective US recession probability has risen to 35% from 20% the prior month. So the right framing is neither alarmism nor denial. It is elevated vigilance combined with disciplined scenario analysis. That takes us naturally into the macroeconomic forecasts. The message here is that the macro picture has become more complicated, but it is not broken. We are maintaining our 2026 US real GDP forecast at 2%, even though stronger first quarter data and solid corporate earnings had previously opened the door to a possible upward revision to 2.2. In other words, before the Iran shock, the direction of travel was arguably improving. The conflict does not erase that resilience, but it does worsen the near-term growth-inflation trade-off and widen the distribution of outcomes. Chart 2 is the first major macro anchor. It shows our quantitative recession model, the Insigneo 4-front recessionary indicator, assigning an 18% probability of a US recession over the next 6 months, up 13% from the previous month. That is a notable move, but it is still not a recession call. And that distinction matters. The chart is telling us that the probability of distribution has shifted to the left, not that the cycle has already broken. So a US recession is not imminent, but the risks have widened materially. To me, that is the right way to read the current environment. More fragile than before, surely, but broken? No. The next pair of charts, 3 and 4, frame the inflation debate exceptionally well. Chart 3 shows that the shock is plainly inflationary in the short run. US 1-year forward break-evens have surged, with the 1-year break-even almost doubling since early January. But chart 4 tells a different story at the long end. The 5-year forward break-even remains much more contained, sitting around 2.1% as of last week. That is a very important distinction. It tells us the market is treating this as a relative price shock, not as the beginning of a new secular inflation regime. Near-term inflation has worsened, but longer-term inflation credibility has not been lost. And because of that, policy easing is delayed, not necessarily canceled. Our view is that rate cuts are now more likely in the back half of the year. But this is also where politics begins to matter. The economic consequences of the war may remain manageable if the base case holds, but the political consequences may be much more meaningful because voter tolerance for a prolonged conflict is limited. Chart 5 makes the point directly by showing that the Iran war is unpopular with voters. And Chart 6 adds a political market overlay. It shows Democratic odds surging in the House race and a much stronger Democratic probability in the Senate, suggesting that the political cost of a prolonged conflict could become material. And Chart 7 goes one step further, showing a market-implied 70% probability that President Trump could be impeached again before January 1st, 2028. Now, whether or not one agrees with that market pricing is beside the point. The point is that domestic political fragility itself becomes part of the macro transmission mechanism. It reinforces the argument that both Washington and Tehran retain incentives to find an off-ramp. So when I summarize the macro section, I would do it this way. Growth is slowing at the margin, inflation is firmer in the near term, and the Fed has less flexibility than markets expected at the start of the year. But the cycle remains intact and will remain so as long as the closure does not persist past mid-April. Labor markets are softer today than in 2022, which makes the economy more vulnerable. Yet, earnings, business investment, and productivity trends have not meaningfully rolled over. We think the phrase contained damage is appropriate here. It is not saying there is no damage. It is saying the most likely path is damage that remains bounded, provided the energy shock does not persist long enough, again, mid-April, to generate a deeper hit to demand, broader earnings downgrades, and a true recession scare. Let me now turn to the market outlook, which is where this framework becomes actionable. Our conclusion is pretty straightforward. Correction risk remains real in the short term, but the medium and longer term backdrop is more constructive than the headlines imply. That is exactly what Chart 8 is about. It is essentially a historical scorecard showing that during geopolitical shocks, commodities and safe havens have generally provided the best hedges. Gold, oil, the yen, the Swiss franc, and the dollar have tended to behave more defensively than risk assets. So the portfolio implication is not to abandon risk outright. It is to build more resilience into the portfolio while uncertainty is high. Over the next 3 months, we favor a more defensive posture with an emphasis on quality, selectivity, and ballast. Specifically, we highlight quality equities, cash, gold, and tips as useful defenses against stagflationary spillovers, while remaining modestly pro-risk over a 12-month horizon. That two-speed framework is important. It avoids the mistake of turning a tactical hedge into a strategic worldview. Near term, be more defensive. Over a 1-year horizon, stay open to upside if the conflict de-escalates and the underlying earnings and productivity story reassert itself. Chart 9 is central here. It shows that earnings have held up materially better than price action. That matters because it means the market has effectively gotten cheaper through multiple compression rather than through a collapse in fundamentals. We still expect S&P 500 EPS growth in the 11 to 13% range this year, followed by about 10% growth in 2027. And on that basis, we maintain our 7,600 year-end target for the index from earlier this year. In other words, further upside is possible, but it will have to come more from earnings than from another leg of multiple expansion. That is a very different regime from the one investors became accustomed to in earlier parts of the cycle. The next two charts are very useful for sector positioning. Chart 10 shows that during stagflationary periods, healthcare and energy have historically performed best. That is exactly the kind of signal you want to pay attention to when oil, inflation expectations, and geopolitical risk are all moving together. Then chart 11 adds an important valuation warning. Global industrials are now more expensive than technology. So the old cyclical catch-up trade has lost some appeal. Our answer to this is a selective barbell. On one side, direct commodity and defense exposure. On the other side, quality secular growers. In practice, our preferred sectors are defense, traditional and alternative energy, utilities, materials, cybersecurity, and hyperscalers. Our constructive medium-term case rests most heavily on chart 12, and I would argue this is the single most important chart in the entire deck. It shows productivity stepping up, with the bar rising from about 1.94 from 1980 to 2019, that's the average, to roughly 2.54 in the period from the fourth quarter of 2022 to the third quarter of 2025. Our interpretation is straightforward. AI is no longer just a valuation story. It is feeding through into capital spending, productivity, and earnings. That does not eliminate short-term volatility, but it does create a more durable earnings floor. In other words, the market has a macro cushion that did not exist in many past geopolitical episodes. That AI and productivity argument then broadens into chart 13, which makes the case that real assets may outperform financial assets in a more fragmented, inflation-prone, security-conscious world. The long historical series in this chart shows that real assets have tended to become more powerful in periods marked by inflation shocks, war, and geopolitical restructuring. The historical evidence leads us to place greater emphasis on infrastructure, energy security, defense, renewables, and other forms of tangible capital formation. It also ties us to one of our core long-term themes, a more multipolar world and what many have called the modern Donroe Doctrine. Not as a crude geopolitical slogan, but as a shorthand for deeper regional integration and a more regionally focused United States. From that perspective, Latin America could benefit where it offers strategic resources, energy optionality, manufacturing relevance, and geopolitical alignment. Let me now spend the remaining part of our time on the view beyond the next quarter and year. This is where the title of the quarterly, Second Order Opportunities, really earns its keep. The argument is that wars did not move markets only through first-order effects, such as oil spikes and equity sell-offs. They also move through second-order effects, where those cost shocks are transmitted into end products and supply chains, and third-order effects, where economies and firms adapt structurally to reduce future vulnerability. Here's a very simple example. Higher oil prices eventually feed into the prices of everyday goods at Walmart through transportation and logistics. That is a second order. Then the reconfiguration of sourcing, inventory policy, and production geography that follows is third order. That framework is especially helpful in the energy discussion. On renewables, we expect the world to move along two diverging paths. In the United States, momentum has stalled under a policy mix that favors fossil fuels and nuclear, even though renewable sources already accounted for more than 20% of U.S. electricity generation in 2022. Europe and Asia, especially China, are moving in the opposite direction in the name of energy security. China is expected to install 270 gigawatts of solar and 84 gigawatts of wind in 2026, and Europe has pushed renewables close to half of its electricity mix. Yet graph 14 makes the crucial point that the shift to renewables will still take longer than many expect. Traditional fuels remain dominant, and the system constraints around grids, permitting, and reliability still matter enormously. So the message of graph 14 is not that renewables fail. It is that energy diversification, not energy romanticism, is the real lesson. We want to emphasize that realism. About 20% of global oil supply and 20 to 25% of global LNG exports move through Hormuz. In some ways, LNG is even more vulnerable than oil, especially because Qatar's exports have not meaningfully land-based alternative routes out of the region. That matters most for Asia, and Chapter 15 captures the cross-country exposure neatly by ranking economies by energy trade balance as a share of GDP. South Korea, Taiwan, Japan, India, and China appear on the importing side. The United States sits roughly in the middle, slightly positive, and countries such as Australia, Canada, Russia, and Norway appear on the exporting side. This is directly tied to market performance. Net exporters have seen equity pullbacks of about 3 to 5% versus 10 to 15% in many net importing countries. In short, the energy shock is not global in the same way for everyone. It is geographically uneven. The last major point concerns industry-level transmission. Roughly 10% of the global container fleet is currently out of position or delayed, but freight rates may not spike as sharply as in prior episodes because firms have spent the last several years redesigning supply chains to be more resilient. That is an important nuance. It means disruption is real, but the system has adapted. Taking a look at sectors, pharma is vulnerable because of its dependence on India, China, Gulf inputs, and thin margin generics. Apparel could face margin pressure, but other emerging markets may gain market share. Semiconductors are exposed through energy intensity and key inputs such as helium, where Qatar plays an important role. Agriculture is highly exposed through fertilizer markets. Conflict-exposed countries account for about 30% of global ammonia exports and nearly 49% of global urea exports, while Brazil imports about 85% of its fertilizer needs. Defense and aerospace are obvious beneficiaries of higher military spending, and industrial manufacturing may gradually relocate toward regions with cheaper and more stable energy, especially North America. That is why the table we published yesterday in our quarterly is so useful. It summarizes the first, second, and third order effects across industries, from oil and liquefied natural gas to fertilizers, agriculture, petrochemicals, industrials, aviation, defense, emerging market currencies, pharma, apparel, semiconductors, infrastructure, and monetary policy. And the common thread across that table is clear, so please take a look at it. Common thread is that geopolitical choke points do not just create temporary volatility, they accelerate fragmentation, rerouting, resilience building, and new investment cycles. In other words, they create both risks and opportunity sets. So let me close with the main takeaway. We are ultimately arguing for discipline over drama. Respect the short-term risks. Respect the fact that recession probability has risen, inflation has worsened at the front end, and the Fed's room to ease has narrowed. Respect also that supply chain and energy disruptions can travel far beyond the initial shock. But do not capitulate to the headlines. If Hormuz disruptions fade rather than intensify, the more durable forces beneath the surface, resilient earnings, still positive global growth, AI-led productivity gains, and the rise of real asset and security-linked themes are likely to reassert themselves. So the right posture, in our view, is simple. Be defensively positioned in the short run, strategically opportunistic in the medium run, and intellectually alert to the second and third order effects that others may still be underestimating. That is where the risk is, but that is also where the opportunity is.
Good afternoon and welcome to our quarterly call with Insigneo. I'm Tamarind and I'm our insurance advisor. Joining us today is Ahmed, our Chief Investment Officer, and Pilar, who is the Co-Chief Investment Officer for Fixed Income for MFS. Thank you for being with us today. There's a QR code on your screen if you'd like to send us your questions, and also through the chat, you can send it the Zoom link. So we'll start with a few questions. Pilar has to leave us a little bit early today, so we'll start with you. The first question is, could you expand on why your base case does not include a global contraction, even considering the current geopolitical backdrop?
Yeah, I mean, I think it's difficult to change your base case yet. And I think the main reason for that is because the starting point for growth, especially in the US, is pretty strong. I think you had sort of a US Goldilocks that was driven by monetary easing expectations, plus the fiscal coming through with the productivity gains in the US economy, giving you a kind of really wonderful picture. And that is still yet, making its way through the base case. Now, of course, the longer this conflict lasts and the longer, the lack of access to oil through the Strait of Hormuz persists, then the harder it is to maintain that base case. It's not like you're calling for a recession, but you certainly have to start factoring in a slower growth, and therefore these ghosts of stagflation come back. And I think that's kind of a little bit too early to call for that. But we are seeing that the fixed income markets, for sure, are certainly quick to price in inflation risks, but not really pricing in any risky assets or pricing in any growth impact. And so for now, we can conclude that, yes, we agree that the base case continues to be for a moderation of growth. But as I said, I think that the uncertainty around the perseverance of the shock in oil prices, plus how long this lasts, is really going to dictate what happens by the end of the year.
And this is as of now, as of today, it's a short-term inflationary shock. Whether it goes on to become a stagflationary shock, or both growth and inflation shock, is obviously going to depend on how long the Strait of Hormuz remains effectively closed. I say effectively because there are some ships going through. We know that. It's not like we've lost all the volume coming out of there, but we've lost a significant part. We've lost enough of volume that we think we probably have 2 or 3 more weeks worth of this. If we're still in the same situation that we're in today, 2 to 3 weeks from now, by mid-April, then, at that point, we'd have to change our recession probably to a recessionary call. Many other places are going to probably get there first. That's for the U.S., right? By mid-April is what we estimate. But yeah, we're definitely in a sort of more stagflationary world than we were as of a few weeks ago, right? Because we definitely have higher inflation, that's for sure. Whether we are having a short-term growth impact, whether it becomes longer term or not, it really depends on the duration of this conflict.
And I think if you want to have something to look at that gives you a little bit of that signal as to whether we need to shift expectations, the perfect timing is now when you have earnings expectations to sort of see if the companies, which will report good first quarter earnings, if there's any inkling that some of these companies are saying we're hiking prices, right? Like the chemical companies are. You just start seeing inklings that they're changing the guidance for the year. And certainly if you see central banks are changing their forecasts, that gives you a little bit of a heads up that you need to start calibrating better your growth versus inflation expectations.
Yeah. Guidance. So going into the second quarter, or the first quarter, I should say, guidance is around 10% for EPS growth. We're slightly higher. But at that number, I agree with you, that's a good marker. If you start seeing that number trickling down, then you're going to see definitely an impact on the S&P, because so far the earnings have done all the heavy lifting. Right. We've had if anything, on the multiple side, it's gone against the index, which is why our view is that it's become cheap, because we're expecting that earnings part to hold up. If it does you could see a strong re-rating from here. Yeah.
Right. The next question, and we'll direct it to you, Pilar. Are you in agreement that it could be possible for the central bank to cut rates twice in 2026?
I mean, I think that's in line with the starting point of the base case that we're thinking about. And again, it's a bit too early to change that expectation. It all gets delayed though, right? So I think originally, especially with the arrival, if we get the confirmation of the nomination with Warsh, there was certainly an expectation that you start cutting rates back to kind of neutral, right? And so the only challenge right now, you're not going to get cuts while Powell is there. So you have to wait. And at the same time, this situation right now, if it drags on, is going to make all central banks and not just the Fed data dependent, which means that the cuts don't get canceled, but they get pushed out. And so you may be in a situation where your base case has to adjust with the timing, but not the direction. I.e., you may push out the cuts to 2027, but you're not eliminating the expectations of cuts in the economy. So yes, base case could still be, cutting to more neutral rates in the U.S. economy because of the weakness of the labor markets mostly. However, it's a little bit early, and you might have to push them out if this doesn't clear out, like you said, by mid-April for sure. Then you have to sort of start thinking about different scenarios.
Yeah, I mean, for us, over the last couple of weeks, the market has started to price in the small probability, not an overwhelming probability, but small probability of a rate hike in the United States. We would lean against that. Our view is that the more likely scenario is that the U.S. Fed is cutting rather than raising rates. Now, they could be cutting for good reasons or bad reasons, right? And let me explain. Cutting for good reasons means that, the inflation shock was a temporary blip. The previous trend reassert itself, and then the Fed, like she mentioned, can, with delay, start implementing those rate cuts that it was expecting. Those are good rate cuts. The equity markets will rally on that. What are bad rate cuts? Bad rate cuts is that, we went over the cliff. We're going to have a dislocation in the unemployment rate, with the labor market in the United States. That's going to start heading higher, and the central bank is cutting our rates because we're headed towards recession. So in both scenarios, good or bad, I think the Fed finds itself cutting rates. The question becomes, are they cutting rates for the right reasons or for the wrong reasons? If it's for the wrong reasons, which again, we don't expect, there's surely going to be a re-rating on the equity market side, because risk assets are not pricing in a bad outcome here. The market is pricing in the taco trade, so to speak. They think Trump is going to back down, and they think Iran is going to back down. Let's be clear about that. If they don't, if either side does not, there's another re-rating coming here.
And by the way, you're going into recession, you're not cutting 50 basis points, you're cutting 200.
Yeah, right.
So then the magnitudes change with the expectations. Yeah.
Right. Pilar, one more question. I know that you're limited on time. What effects do you foresee in the global economy if oil prices remain elevated for longer?
I mean, I think that unfortunately, physical access to oil is very important, not just for energy-dependent sectors, but just across the board, right? So I think that the challenge is that it leads to higher anchoring of inflation expectations because, basically it just permeates everything from semiconductors to agriculture, et cetera. And then it starts becoming a drag on growth. Now, it all depends on how much, like where's all that? I mean, if oil is at 80, it's very different than if you're at 120, right? So I think that perseverance of this crisis for a long time with an oil price around 100 is going to start breaking things at some point. For sure, if you get to 150, then all bets are off. But I do think that there is significant differences between which region you're talking about. And of course, Asia is the one that suffers the most. And if the obviously oil price continues to be at the highs, and then you have to worry really about physical access to the commodity rather than the price. If you don't have oil, you don't have oil. And I think that's where things start becoming really, really difficult for global growth. With differentiation between the regions and the countries that you're talking, whether you're a commodity exporter or not.
Right.
Yeah, I think, the U.S. will benefit on a relative basis, right? I mean, it'll still suffer, but it'll suffer less. And that's been reflected in the risk moves since this crisis began, right? U.S. markets have fallen, but they've fallen a lot less than other markets. But if you want to keep it outside the U.S., I think a region that benefits a lot is Latin America. Latin America will benefit vis-a-vis Asia, vis-a-vis Europe, if this crisis prolongs, because so many countries in Latin America benefit from higher commodity prices, right? So they'll benefit from higher oil, they'll benefit from higher like agricultural costs, metals costs, all those things. So I think relative winners in this scenario is the U.S. and Latin America. Those are two prime areas I think that will benefit.
Yeah, and what's interesting in fixed income, that the developed markets and emerging markets have behaved similarly in terms of their yield curves, right? Yeah. And again, some of these dislocations don't make a lot of sense. But because it was such a crowded trade starting the year to be long emerging markets, not just hard currency, but especially there was a lot of money going into local rates in emerging markets, that you're starting to see huge swings in pricing. And I'll give you an example, Mexico. Mexico, before this all started, was pricing in 2 cuts by Banxico, which, by the way, is meeting today. And, we expect either for them not to change or to cut 25 basis points and then become data dependent. But we've moved in from pricing 50 basis points, pricing at 150 basis points of hikes. And the rate is at 7%, which is already restricted. So you see these big dislocations in emerging markets and fixed income, right? Even more so than obviously what's going on also in equities as well, even though some countries are still benefiting from terms of trade. And so, for example, Colombia, Banrep is meeting on Friday, and they're very different, right? So there we expect 100 basis points of hikes and another 75 to follow. Why? Because the central bank has to react to Petro's policy of increasing minimum wages by 23% to re-anchor inflation expectations. So they're in a very different position than, Brazil, which we still expect cuts to come through, right? And so I think that there is a way to sort of create opportunities within even your Latin American fixed income exposure to take advantage of countries like Peru or Chile, which are not going to do anything, and countries where you still see those cuts coming through, and others where you have to step aside and wait for some of the re-anchoring of inflation expectations to kick in.
Yeah, I think that's super interesting because the dispersion you're seeing among markets is a very real thing. It's a relatively new phenomenon, right? I mean, 10 years ago, everyone was hiking or cutting rates in the same cycle. Everyone was, growth up, growth down. Now you're seeing this sort of dispersion of outcomes that, some central banks are hiking, others could potentially be cutting, some are staying put, some economies being, negatively impacted, some being positively impacted. So you can't paint a broad brush anymore with them, especially with emerging markets, right? You need to be very surgical, I think, in how you invest in the space, right? Which is something that wasn't you either loved the asset class before or hated it. So I think that's a very interesting thing to have developed recently.
It is an interesting point. Pilar, thank you so much for joining us. I know that you have another meeting, so we'll take a break and we'll come back with Ahmed. Thank you.
For having me. It's been a pleasure. I hope I can do it again.
Okay, thanks. Thank you for joining us. We're back, Ahmed and myself, and we have a few more questions coming in. Ahmed, the next one is, given your view of a more multipolar world, what is the best way to position investment portfolios?
Yeah, so this has been a long-standing view of ours, right? That we've left the unipolar moment, and we're now in a multipolar, at best, bipolar world. But what let's say, what does that look like? It means, obviously more conflict, more sort of spheres of influence, more nations pursuing their interests independently of a global kind of hegemon. So what do you want to own in those moments? Well, that graph is very clear. You want to own real assets over financial assets because they will outperform. What are real assets? Properties, infrastructure, gold, commodities. You want to own stuff, right? If you want to think about it that way, stuff that comes out of the ground, stuff that has to be built. All those things will tend to outperform purely financial assets over periods like that.
Okay.
Yeah.
Well, thank you. The next question is, how do you view renewable energy today? Is it still an attractive investment, or should the focus remain on traditional fossil fuels?
I think energy today means everything, and I think this sort of this crisis that we're doing is going to be, for those who had not heard the wake-up calls yet, this is like the second and third alarm bell that people need. Eventually people will have to get out of bed. Renewable energy to me is not a question of whether you're a tree-hugging liberal and whether you even love the environment. It's a question of energy security. Countries need as many sources of energy as they possibly can get, and no country is in any position to reject any possible energy input, right? So fossil fuels, right? So Europe has to stop shutting down its coal plants. The US has to stop shutting down its coal plants. But at the same time, they need to build up renewables as well. So energy security is about having as many different sources of energy as possible that aren't susceptible to the closure of the Strait of Hormuz, that aren't susceptible to one country saying, well, I'm going to shut this down. That's what energy security is about. So I think, to me, the energy sector is a very attractive place to be invested for the long haul, not just for this crisis, for the long haul.
Okay, thank you. You mentioned the importance of second and third order effects related to the current Iran conflict. Could you explain how these may impact different economic sectors?
Yeah. Well, one is, for example, energy, the one we just mentioned. It means having exposure beyond the traditional oils to, to renewable place, to nuclear. That has been a big theme of ours for a very long time. We think this only gives even more impulse to that nuclear energy theme. But solar, wind, you kind of need to be diversified. Battery storage, all these kinds of things are places that you need to be invested in because I think they will benefit over the long term. But what are some of the second and third order? Well, we maybe need to rethink our premium on the Gulf states, right? Part of what made the Gulf states so attractive was that they were relatively insulated within the Middle East. Now you're seeing them get hit. So maybe Microsoft decides, well, maybe that data center, I don't want it in the United Arab Emirates. I would rather have it in Mexico. So I think, a place like Mexico is going to benefit at the expense of the Gulf states, for example. So those are the second and third order effects. To me, the other thing that it does is that this only increases China's and Russia's decoupling from the Western world. I don't think this brings them closer. I think this actually pushes them further and further out because they realize their vulnerabilities. So you're likely to continue to see this sort of dollar-based world, and then the world where the dollar has less relevance. For the dollar-based world, and basically the Western world, so to speak, the dollar will remain king. But outside that, you're going to start thinking like crypto assets, gold, digital assets, commodities. That will be more a store of value. So those are those second and third order effects that I think are important down the line.
That's interesting. Okay, and then another question that we have is, which equity sectors do you consider most attractive in the current investment environment?
Yeah, so, tactically, and when I say tactically, I mean over the next, 3 months or so, over the next quarter, I think you'll continue to see what has been outperforming since this conflict began outperform. So those are things like, defense, energy, utilities, more defensive sectors that are not cyclical in nature. Over the 12 months, I think those cyclical sectors will return to outperformance, but I don't think they're going to outperform the same way that they did to start the year, right? To begin the year was almost a consensus trade that almost everything outside of the United States was going to perform better. I think that will eventually return, but I think that the gap between the U.S. and ex-U.S. is not going to be nearly as wide. Think about this. Right before the Iran conflict, ex-U.S. was outperforming the U.S. by like 11%. So that's been the biggest outperformance of the rest of the world versus the United States for a very, very long time. I think once this conflict passes, if it passes the way that we think it will, the rest of the world will start outperforming the U.S. once again, but it won't be by 11%. It'll be by maybe half of that. Because I think one thing that this conflict is going to solidify in the mind of investors and politicians and governments around the world is that we need to add some risk premium to things like energy and gold and other commodities, because they're not as secure as we thought they were going to be. So oil, even though I do think oil is headed lower, I don't think it's headed back down to $60. I think it's going back down to 70, 75, $80, but not back to $60, because the world's going to realize like these supplies are somewhat of a risk. So I need to attach a risk premium to them that I maybe was not doing before.
Right. I see. The next question we have is, could you elaborate on your positioning for the rest of the year, both from a tactical and structural perspective?
Yeah. So as I mentioned during the call, we had told advisors to put on a tactical long oil hedge just in case this happened. It happened. So we told them to remove it the first week of March. So a week after the war began, we removed half of that tactical hedge when Brent was approaching $100. We still have it on. Our next move is going to probably be to remove that if the war, let's say, unfolds the way we expect it to. We will eventually remove that hedge. If it doesn't, we're going to keep that hedge. So tactically, I think it makes sense to be defensive. It doesn't make sense to take a lot of risk right now because we're sort of in a binary outcome here. But I think over the long haul, I think those trends that were ongoing before the year they will reassert themselves. They'll just reassert themselves at a slightly less, let's say, performance level than before.
Understood. All right. The next question we have is, what are your preferred ideas for investing in artificial intelligence?
That's a great question. I don't think it's through the hyperscalers, which is the way everyone tries to invest in there. Well, let me actually take a step back. I think in this space, you definitely don't want to invest via fixed income or credit. You want to invest with equities because a lot of these companies are not going to be around in 10, 20 years. We don't know who the winners are going to be.
Right.
So why would you buy bonds? You need to buy equities in these companies because if you buy 5 bonds, let's say 5 AI bonds, maybe 1 or 2 of them won't be around. That kills your total return profile. But if you buy 5 equities, 1 or 2 are not around. It doesn't matter because the other 3 have made so much money that you've made money overall, like on the strategy. So AI, you invest via equities, not via credit. You only invest in credit in sectors that you have predictable cash flows. These AI companies are the opposite of predictable cash flows. We don't know where the cash flows are going to be. They might be through the moon. They might be zero because they go under. So don't invest in credit. Don't buy AI bonds. Buy AI equities. That's the way to do that. The other thing is that you want to have hardware for sure, but that trade's already in, right? The semis have had a great run. So go to the second and third order beneficiaries of AI, energy, batteries. That's one way to play this, right? The way to play this now that hasn't been played yet is all the support structure for the AI plays. Think about it. If this was a gold rush, you don't want to be buying gold mines and you don't want to be buying gold. You want to be buying the companies that give you the axes and the brushes to do the gold mining. That's what you want to do in the AI space.
Right.
Yeah.
That's interesting. Could we have time for one more question? Did I ask you which equity sectors do you consider most attractive in the current investment environment?
Yeah, that's similar to the one we had before. But again, just to repeat, I know that question has been coming in a lot. You know, defense continues to be one we like a lot. The energy sector is one that we like a lot. And again, energy broadly speaking, not just big oil, you know, oils, nuclear, renewables, the whole space. Utilities, another sector we like quite a bit. You know, industrials, and I think tactically tech makes a lot of sense. Tech, I mentioned it earlier. Tech has re-rated where it's now as cheap as the industrial sector is, as cheap as many of these cyclical sectors are. So I think tech makes sense again. You know, some sectors became very, very cheap, like software. Software erased 6 years of gains in that sector. I think that doesn't make sense.
Okay. Well, Ahmed, I want to thank you for joining us today, for being here, and thank you all as well for joining us, and have a great day.
Thank you.